This is Nightly Business Report with Sue Herrera and Bill Griffin.
Not so speedy delivery. FedEx cuts its full-year profit forecast for the second time this year, and it is blaming a worldwide economic slowdown. Playing to win, Google is making a big push into the video game industry, and it could change the business as we know it. Denim debut, why the company that invented blue jeans is getting ready to return to Wall Street. Those stories and more tonight on Nightly Business Report for Tuesday, March 19th. Good evening, everyone, and welcome. Bill is off this evening. We begin with a company that has become synonymous with the global economy, FedEx. The company, which ships more packages when activity is strong, reported quarterly results below Wall Street estimates, and the future doesn't look much better. FedEx lowered its full-year outlook for profit again, citing a slowdown in global trade. The logistics company earned $3.03 a share, missing expectations. Revenue was up from last year, but below consensus forecasts, and that sent the stock lower in initial after-hours trading. Kate Rogers has more on FedEx's results.
The big thing to focus on here, continued impacts of a global slowdown on the company's business. CFO Alan Graf said in a statement, slowing international macroeconomic conditions and weaker global trade growth trends continue, as seen in the year-over-year declines in our FedEx Express international revenue. The company also once again lowered its guidance for the full-year EPS with a weaker Q4 range than anticipated due to concerns over global trade growth. This comes after lowering guidance last quarter, citing weaker international business, particularly in Europe. For Nightly Business Report, I'm Kate Rogers.
So let's turn now to Donald Broughton for more on FedEx's results and what those numbers may be telling us about the health of the global economy. He is managing partner at the independent research firm of Broughton Capital. Nice to have you here, Don. Welcome.
Nice to be here. Thank you.
All right. What do you make of this results? Obviously, the street thinks that it does not portend anything that on the very good side for the global economy. But what about you? You say you're generally speaking an optimist.
Well, I really am. And this is the company that's going to deliver e-commerce in the coming years and decades. But the bottom line is they're just following through on what they told us 90 days ago, which is that if you look at air freight numbers, volumes in Europe, you can blame it on Brexit, you can blame it on whatever, but the rates of volume there continue to decline. But more concerning is that since that last release 90 days ago, in the interim, not only did they get proved right about Europe, but the rates of decline in air freight volumes in Asia have really stumbled and fallen.
You know, those two issues that you bring up, Asia, the U.S.-China trade war, and Brexit, both of those remain largely unresolved. We may be getting a little bit of progress on trade. So that does not really portend a bright future for FedEx, does it, if it still has those two clouds hanging over it?
Well, it doesn't pretend a bright future in the short term. That's granted. But what I would tell you the air freight numbers in Asia tell you is that, quite frankly, China needs to do a trade deal more desperately than we do, which raises my confidence that one will actually get done. And eventually one will, and then the dominant player in that market, FedEx, will be the biggest beneficiary. Brexit will eventually get settled, and as it does, hopefully we'll get a relief and we'll get some improvement in volumes there. And again, FedEx will be a beneficiary. The domestic economy continues to.
What do you do with the stock in the time that we have left?
We continue to be a long-term bull about the company and its prospects, and as a result, its stocks. If you look at how well they are managing their operations, their technology, they move things more efficiently and make more money on every package than they ever have. But they can't control the macroeconomy, they can't control Brexit, and they can't control Trump and the trade tariffs and trade war.
Indeed. Don, thank you very much, as always. Don Broughton with Broughton Capital.
My pleasure.
On Wall Street, the Dow snapped its four-day win streak after a report that Chinese officials are pushing back on U.S. trade demands. As a result, stocks ended mixed. The Dow fell 26 points to 25,887. The Nasdaq rose 9, but the S&P 500 fell ever so slightly. Bob Pisani has more.
The market's whipsawed on a couple of conflicting headlines about U.S.-China trade talks. The Dow Jones Industrial Average snapped a 4-day win streak. Stocks had rallied early ahead of tomorrow's Federal Reserve meeting, per its usual pattern. In fact, the Fed itself has conducted studies on what is now called the Fed drift. It's the tendency for stocks to drift higher in the 24 hours preceding a Fed announcement. The Fed's found this phenomenon puzzling, but it does exist. But the S&P 500 passed below the day's prior low late in the day, and we saw heavy selling pressure pick up, and the rally fizzled out by the close. Still, stocks have held up very well recently. Crude oil prices are hovering around 4-month highs, and there's definitely hopes for a trade deal. We're getting very close to the final stages of negotiation. Recent headlines suggest the U.S. and China are in very intense negotiations. China wants assurances that the tariffs will be eliminated as part of a deal, and that's certainly a sticking point. U.S. Treasury Secretary Steve Mnuchin still scheduled to go to Beijing next week. China's vice premier is slated to travel to Washington the following week. So negotiations are really intense right now. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
There are new developments tonight related to Boeing. The Department of Transportation has asked its Inspector General to audit the FAA's certification of the Boeing 737 MAX following 2 fatal crashes involving the aircraft since October. Boeing says it will fully cooperate with the audit. Separately, there are reports that former Delta executive Steve Dickson will be nominated by the White House to head the FAA. And as Bob just mentioned, Federal Reserve policymakers began their 2-day meeting today. The central bank is widely expected to hold interest rates steady when they announce their decision tomorrow. Ahead of that decision, Steve Leisman surveyed market watchers to get a sense of where they see the market and the economy heading.
As Fed officials huddle to set interest rates at their March meeting, a new survey shows Wall Street preparing for slower U.S. growth this year, and some thinking the Fed might even cut rates down the road. The CNBC Fed survey for March sees growth slowing to 2.3% from 3.1% in 2018 and bumping down again in 2020 to 2%. The 43 respondents, who include economists, strategists, and fund managers, point to slower global growth and trade tensions as the leading threats to the U.S. expansion. The two could possibly shave more than 0.5 point together off of growth this year.
I think the global economy is still in difficult shape, and I don't think the economy is going to snap back that much. I think the economy is in a little bit more trouble.
On the other side are those in the survey who are more optimistic because they think the tax cuts this year could continue to deliver additional growth.
It's unrealistic to believe that all of the beneficial impacts of the tax cut on investment took place in a 6-month period.
Right.
These are multi-year projects. They take a long time to be planned, executed, delivered, and then incorporated into business practices.
In bringing down growth forecasts, respondents also brought down their outlooks for rate hikes this year from the Fed. At the height of the bull market last year, respondents thought the Fed would hike rates as many as 3 or 4 times in 2019. That's been pared back, where barely 1/4 point hike is now expected. Next year, most are betting on a single hike, but 35% think the Fed could even cut interest rates. So the Fed is seen as on hold for now, but investors are on the lookout for whether more than just patience is needed from the central bank. For Nightly Business Report, I'm Steve Leisman.
The news tonight takes us to the Midwest, which has seen devastating and historic flooding. Most of Nebraska is under a state of emergency. According to some early estimates, Nebraska's agricultural sector could face nearly $1 billion in damage and loss. Agriculture accounts for 20% of that state's economic activity. Livestock accounts for nearly 60% of Nebraska's agriculture revenue. And some say flooding could prevent farmers from planting next year's feed crops. It is time to take a look at some of today's upgrades and downgrades. Domino's Pizza was upgraded to overweight from neutral at J.P. Morgan. The analyst cites the potential for double-digit sales growth. The price target is $270. The stock was up more than 2% to $248.76. Union Pacific was downgraded to hold from buy at Loop Capital Markets. The analyst cites the problems posed by the flooding in Nebraska. The price target is $182. The stock fell more than 3% to $160.75. Noble Energy was upgraded to buy from neutral at Mizuho. The analyst cites the company's free cash flow. The price target is $29. The stock was up a fraction to $24. Coming up, big tech is making a big push into video. We'll explain. The top antitrust Democrat is calling for the FTC to investigate Facebook. The chairman of the House Judiciary Committee's Antitrust Subcommittee wants to know whether the social media company's conduct violated antitrust law. In a New York Times op-ed, the congressman encouraged the FTC to take a tougher stance against the country's largest tech companies. And he cited the Cambridge Analytica scandal and Facebook's handling of user data, among other issues. Well, there is big money to be made in the video game industry, and Google wants a piece of it. The tech company made its intention known at the annual Game Developers Conference in San Francisco, which is where we find Josh Lipton.
To build a game platform for everyone.
Google's CEO, Sundar Pichai, took the stage today at the Game Developers Conference in San Francisco, where he announced his company's big push into the $135 billion video game market. It's called Stadia, a new game service for devices running Google's Chrome browser. And Google hopes it will upend the traditional video game market because it means fans will soon be able to stream complex, high-level games over the internet right to their phones, tablets, and televisions. No need for PCs or expensive game consoles. Google executives say Stadia is a game changer.
As we said in our presentation, we want games to be available to everyone without the barriers or the limitations of the hardware that they may have in their home. We'll take care of the hardware in our data center, and all you need is a laptop or a PC or a TV to stream to. So you don't have to have that expensive custom hardware to get the best possible game experiences. And over time, we think that will dramatically increase the game audience for everyone.
Google isn't saying exactly when Stadia will launch, only that it's at some point this year. And the company isn't yet detailing the business model either. Will it be a subscription, or will Google take a portion of all proceeds spent on Stadia? There's plenty of competition when it comes to video game streaming too. Microsoft is pursuing this technology, so too reportedly is Amazon.
Analysts say that one question is whether the big game developers now buy into this vision and partner with Google. That could mean giving up some of their games' proceeds. Is that worth it to potentially reach that many more gamers around the world? For Nightly Business Report, I'm Josh Lipton, San Francisco.
A media milestone has been reached. For the first time, more households subscribe to a digital streaming service than to traditional pay television. According to a new survey from Deloitte, 69% of respondents pay for internet video versus 65% for cable or satellite television. The trend was most pronounced among Generation Z, where 80% subscribe to internet video only. Netflix says it has no plans to make its shows and movies available on Apple's upcoming video offering. CEO Reed Hastings says he wants customers to watch Netflix content on its service. Joining us now, Brett Sappington, Director of Research with Park Associates. Brett, nice to have you here. Welcome.
Glad to be here, Sue.
This is such a fascinating space to me, and it's one where you're getting new entrants into it all the time. You say there are going to be a number of winners in the space, but you single out Netflix. Why?
Well, Netflix is the leader. They're the dominant leader by a significant margin. Over half of U.S. households have a Netflix subscription right now, and that's significantly more than anyone else. The next closest is Amazon.
What about Apple's entry into it? Do they have an uphill battle to fight? I mean, they're a very, very innovative company, certainly, and they want in on this space. And Netflix doesn't want to do business with them in this particular niche at this point. What does Apple have to do?
Well, I think anyone entering the online video space right now for subscription services, everyone has kind of an uphill battle to try and rival Hulu, Amazon, and Netflix. But there's no company perhaps that's out there other than maybe Facebook or others that has a better path to success than Apple. Apple has iPhones, they have iTunes, they have smartwatches. They've got a number of ways to be able to both get services to consumers and to promote their service.
What about content? Does it come down to who can create the most original content? Or does it come down to who can aggregate the content from other players, or maybe both?
It really does come down to content. You don't subscribe to a service unless you're interested in watching what it has. So for Apple to be successful, it needs to have good distribution, and it needs to have a unique reason for consumers to pick them either over other services or in addition to the other services that they pay for.
What does Netflix have to do to maintain its dominance, Brett? I mean, as we mentioned, Apple is a very innovative company. A lot of these companies that are in this space, you know, their bread and butter is innovation. So what does Netflix have to do to stay in its lead position?
They have to continue to produce good content, and they've proven very adept at doing that. In fact, what we've seen from Netflix is a significant portion of their library has gone from movies and television shows to original content and original programming. They're winning awards, they're gaining subscribers both here and internationally. So they just need to keep up that momentum. It's going to be difficult, particularly with a number of known brands entering the market.
On that note, Brett, thanks so much. Brett Sappington with Park Associates. Well, the other shoe drops at DSW, and that's where we begin tonight's market focus. The shoe retailer reported a surprise quarterly loss. Analysts had been expecting a profit. The company cited higher overall expenses and an increase in inventories. DSW's CEO also announced a rebranding effort that includes a name change to Designer Brands. The stock fell nearly 13% to $22.09. It was a different story, though, for Michaels. The arts and crafts retailer reported better than expected quarterly earnings, which helped offset guidance that was below consensus. The company plans to open 24 new stores during the new fiscal year. The stock was up more than 8% to $12.79. Goodyear Tire plans to cut 1,100 jobs in Germany. The company says the decision is part of its plan to modernize manufacturing facilities. The move follows Ford's announcement just a few days ago that it plans to cut about 5,000 jobs in Germany. The stock closed up a fraction to $17.92. Weak sales data is sapping the energy out of the shares of Monster Beverage. A Wall Street analyst citing Nielsen data says sales were down more than 3% in the week which ended March 9th. Rival energy drink maker Bang saw sales rise in that same week. The stock fell more than 4% to $57.92. Well, Levi Strauss is credited with creating the first pair of blue jeans. The company is one of the dominant forces in the industry, and investors will soon be able to buy shares of the denim pioneer. Courtney Reagan has more on the company's upcoming IPO.
Denim lovers can invest in more than just a pair of Levi 501s when the 166-year-old company goes public for the first time in more than 3 decades on Thursday. Levi Strauss is the top seller of jeans in the world, and its Wall Street debut comes amid big changes in the industry. Competition is stiff from the likes of Wrangler and Old Navy. Rival Wrangler parent company VF Corporation is spinning off its jeanswear business into a new public company, and Gap Inc. is spinning off Old Navy into its own publicly traded entity. These newly public companies come at a time when jean sales are forecast to improve globally, though at a slower rate than over the past 5 years. And one of denim's biggest challenges has been athleisure.
Athleisure is a concern for the category, broadly speaking. However, with that said, I think Levi's in many ways defines the category.
As consumers buy more stretchy, casual clothing, companies including Nike, Adidas, Lululemon, Under Armour, and Gap Inc.'s Athleta gain apparel share in the U.S. As Levi, True Religion, Gap, J.Crew, Banana Republic, and Ralph Lauren lose apparel share, according to research from Bernstein. But NPD sees the trend turning, forecasting women are looking to replace yoga pants with jeans this year.
Denim is one of those categories that will cycle in and out of popularity, and certainly in recent times has been experiencing an upswing.
That's good news for Levi's women's business, which is less than 30% of sales, but growing. It's also good for the competition. American Eagle Global Brand President Chad Kessler says his brand is #1 for women in the U.S. and, quote, growing rapidly. And he expects significant growth to continue in both men's and women's jeans this year. So why go public now? Levi Strauss says the offering will give it more financial options. But experts point to another motivation for the dual share class IPO that gives the descendants of the founder's family 10 Class B votes to every 1 vote of the Class A investors, or nearly 81% of the voting power. Investors hope that history of profitability and sales can continue for years to come. For Nightly Business Report, I'm Courtney Reagan.
Coming up, is the item listed on that e-commerce site real or fake? With the U.S. and China in the middle of a trade war, it might be harder to know. Peloton was hit with a $150 million lawsuit. A group of music publishers alleged that the maker of video streaming exercise bikes used more than 1,000 songs from well-known artists without permission. The publishers say Peloton failed to license songs from the companies, and that resulted in a loss of income. Peloton says it is evaluating that complaint. As the U.S. and China continue their trade war, and it heats up, in fact, Chinese nationals may have found a surprising way around the tariffs, increasing the number of counterfeit goods, according to the FBI. China is behind an ever-increasing number of fake products and is now targeting American trademark records in a quest to gain access to e-commerce sites and American consumers. Andrea Day has the story.
This is the Federal Inspection Station at JFK Airport, a massive warehouse where almost every package coming into the United States through New York City must pass through.
We're talking about, anywhere from 800,000 to 1 million pieces of mail a day.
That's $92 billion worth of legitimate trade in just this past fiscal year. Frank Russo is the JFK Port Director for Customs and Border Protection. The mission? Keep the real goods flowing and stop imposters in their tracks. A challenge, he says, like never before.
We've seen a big spike, certainly of just volume.
From phony guns, jewelry, and guitars.
Just in the last 72 hours, all of these products came in here.
Absolutely, yeah.
To what's behind these doors.
This is our most secure room.
The room loaded with potentially counterfeit drugs and more.
Everything from pharmaceuticals, tramadol, oxycodone, to ecstasy, MDMA, to counterfeit money, counterfeit IDs.
Fueling the spike, he says, e-commerce and smaller packages headed straight for the consumer.
An incredible uptick in e-commerce.
And some of these new super fakes, he says, are so real, it's almost impossible to tell the difference.
Was this on its way to a consumer?
Probably. Somebody ordered it online.
Fake or real?
Fake.
Fake. Where are we seeing most of these counterfeit products coming from?
Certainly China, one part of the world where we're seeing an ever-increasing number of counterfeit goods.
We wanted to find out what's behind this virtual epidemic of fakes coming in from China and how so many are winding up on e-commerce sites for sale.
It's driving up cost for our clients.
Diane Finguera Ducharme specializes in trademark law. She says imposters are trying to hijack her clients' luxury brands by duping the U.S. Patent and Trademark Office, or USPTO, so they can register as the brand on sites like Amazon.
They file a document with the Trademark Office that says our email address has changed. Then they go over to the Amazon brand registry and they say, we're the owner of this mark, and they give their email. Amazon then looks at the USPTO records and confirms the email. At that point, Amazon gives them access to all of their tools as the rightful brand owner. With access to those tools, they can take down legitimate product and they can ensure that their own counterfeit product is sold on Amazon.
So you're saying it could be as easy as just changing an email to start this process?
I'm saying it is as easy as changing an email.
Amazon tells us in part, we remove suspected counterfeit items as we become aware of them. Amazon's proactive technologies and services for protecting brands, including brand registry, are increasingly effective. As a result, bad actors are attempting to find new ways to abuse our protections. We are working closely with the brands, the USPTO, and others to continue to strengthen our protections.
It's unbelievable how easy it has become.
When an email address is changed, the Trademark Office sends out an alert to the old address to confirm. But Ducharme says they can easily be missed or even ignored by a brand.
For my clients alone, I received about 12 or 15 of these email alerts.
Every day I come in and I find a new product category that counterfeiters are producing and faking.
Stephen Shapiro is the unit chief for the FBI's Intellectual Property Rights Unit.
They'll communicate with the Patent and Trademark Office as if they're the actual brand holders in an attempt to change the contact information.
And as trade wars intensify, he says criminals are looking to e-commerce and selling any way they can.
There are some that feel that as tariffs increase and other policy issues come along, that counterfeit is seen as an alternative route towards making additional profits. It's very difficult to monitor every single seller operating on these platforms because they are massive and they do have millions of transactions a day.
The USPTO tells us it takes the issue of fraudulent, unauthorized, and improper submissions very seriously and is working right now to identify those filings and stop them from being processed or causing any harm. I'm Andrea Day for Nightly Business Report.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. We'll see you tomorrow.